Hello and welcome to Mortgage Mastery. I'm Kara Lowrie with Acadiana Mortgage, and today we're going to talk about credit scores. So ultimately, when you apply for any type of loan, the lender has to prove or demonstrate two things. They have to show your ability to make your payments and your willingness to make your payments. So the way that we verify your ability to make your payments is coming from your stability of income, your income in relation to your debts, from a monthly payment standpoint, can you afford to make the payment? And then when we're proving your willingness to make the payments, ultimately we're using credit scores to do that, because ultimately a credit score is a snapshot in time of your credit history. The most recent credit weighs the heaviest, and so sometimes that's why you will hear, if you have a really old collection account, it's best not to pay it off because it may be reporting very old. Now, if it's reporting very new, that's a completely different story. But anyway, back to credit scores. So if you could independently apply for a mortgage loan, a car loan, and a credit report, a credit card all at the same time, then all three of those scores would be different. And they're all different because they're all weighted differently. Credit scores are basically an algorithm which takes into consideration your length of credit history, how many accounts do you have, how many of those accounts have open balances, late payments, or are they all paid on time? Is it a installment? Is it revolving? Are you an authorized signer? Are you a co-signer? So all of those things go into that algorithm to determine the credit score. So credit scores are very, very important. All loans now basically are based on credit scores. And so that's why it is so imperative to make sure that you are looking at them, that you are working on what are the items or what are the things that you can do to actually bring your credit scores up. And what is best for you is not necessarily the same thing that is best for the next client, because you have a starting point, and that starting point is your current credit score, your current credit history, and what is based or what is on your credit report that is producing that output of that credit score. So if you have no credit, then obviously you may have no score, or you may have a very, very low score. So you may need to actually get some credit, pay it on time for 4 to 6 months so that it will actually generate a score. If you have a lot of credit, but all of them are maxed out, or all of them have balances, then it may be that you need to pay some down, you need to close some out, you need to pay some off and close them out. There are literally many, many scenarios on trying to define or figure out what is the best for you as a client. So we can run simulators to determine that, because it literally is an algorithm, garbage in, garbage out. When we run the simulators, we can tell you exactly do A, B, C, and D in that order and precisely that exact thing. And I've never had a simulator not come out or not produce the credit scores that we were told that it was going to produce, assuming you do those exact steps. For example, if you're told to pay down a credit card to $52, then you pay it down to $52, not $50, not $51, not $60, $52. If it's that you need to open up a new account and you need to have that account for 4 months or 5 months or 6 months, then again, it is precise. So the simulators can be a really beneficial tool to determine what you need to do with your credit history. We do suggest using companies like Credit Karma. Credit Karma is not good from the standpoint of that's what your mortgage score is going to be, because it is just a raw score. It's not a mortgage algorithm, so it's not going to give you a mortgage score. So Credit Karma, services like that are used to kind of monitor what your scores are doing, monitor the trajectory to see what is happening, but be sure and look at those reports to determine how old they're reporting, or how recent they're reporting. For example, you may have a Visa card, but it hasn't reported for 3 months. Now, that doesn't mean Visa hasn't reported. That just means Credit Karma hasn't picked it up in 3 months. So just be cautious of that. So Credit Karma does serve a good purpose there. But that's kind of a brief overview of credit scores and give you a little bit of institutional knowledge of how that works. So don't forget to like our videos, subscribe to our channel, and please look at all of our other short videos that are out there. This is Kara Lowrie, and thanks for watching.